Welcome to Call Wiz, where we break down earnings calls. Today we are on Bloom Energy, ticker BE, and the second quarter of fiscal 2026, the quarter they finally cracked $1 billion of revenue in a single period.
And not by a little. There is real substance under the headline.
Right up front, revenue 1.065 billion, up 166% year over year and 42% sequentially. Non-GAAP gross margin 34.3%. Full year 2026 outlook raised to 3.9 to 4.2 billion. KR Sridhar and CFO Simon Edwards on the call. Reported July 28th.
First $1 billion quarter is what everyone will paste. The question is whether the rest of the story holds when you dig.
Chapter 1: The Milestone. KR's arc 21 years to the first $1 billion year in 2022. 3 years to double it, now guiding to double again in a single year after the first $1 billion quarter. Product revenue 935 million, up 215%, nearly 90% of total. GAAP diluted earnings per share 62 cents, non-GAAP 78 cents. Cash 2.7 billion, with Simon reporting 226 million of operating cash flow and 175 million free cash flow in the quarter.
That cash generation while growing this fast jumps off the page. Filings show they were still burning hard in the second quarter of 2025, operating cash flow negative 213 million that period. The swing is real, and the balance sheet now sits roughly net cash after the debt paydown.
And backlog is now growing faster than revenue. New mega customers place longer term orders after the first shipment. Several who had alternative solutions abandoned them for Bloom this year, and some of those ship inside the same fiscal year they booked.
Walk the margin stack. 34.3% blended non-GAAP is a big print.
Gross margin up 604 basis points year over year. Product gross margin 37.2%, up 193 sequentially and 291 from the year ago quarter. Service margin 22%, up 977 basis points. Fifth straight double-digit quarter. Non-GAAP operating income 240 million. Operating margin 22.5%. Adjusted EBITDA 253 million, about 24% of revenue.
Operating leverage is the line management wants remembered. Revenue up 166%, operating expenses up only 48%. Simon said R&D and G&A are largely fixed against a rapidly growing revenue base, and support functions scale with automation rather than headcount. Structural, not a one-quarter effect. Each incremental gigawatt carries little incremental overhead.
Filings back that up. Annual operating margin was still deeply negative in 2022 and 2023, only 3.6% in full year 2025 on 2.02 billion of revenue, and now low 20s non-GAAP in a single quarter. GAAP operating income this quarter was still 182 million, so the adjusted figure is doing real work. Service is the quiet win too. At IPO 8 years ago, service margin was negative 21%. Now plus 22, a 43-point swing. Analysts used to obsess over service losses. KR now calls service a driver of enterprise value.
Guidance puts real money behind the confidence. Full year revenue 3.9 to 4.2 billion, about 100% growth at the midpoint over 2025's just over 2 billion. Non-GAAP operating income 800 to 900 million, up from 425 to 450 million at the start of the year. That implies roughly 21% operating margin versus about 14% on the original guide. Non-GAAP diluted earnings per share 2.55 to 2.85. Gross margin held at approximately 34%.
They will not protect every quarterly margin point if expediting wins a multi-year customer. Time to power is what customers value most, and over a full year that is still consistent with the 34% rate. Outlook is bottoms up in two layers: backlog conversion against site readiness, plus reserved capacity for in-year time to power bookings. What used to look like seasonality is now delivery timing.
Chapter 2 is the strategic claim. From first direct hyperscaler, Oracle 55-day delivery announced last year, to validated standard across the AI ecosystem in less than 9 months. KR's line, This is not a faster horse, this is a car.
All major US hyperscalers and over a dozen neoclouds, AI labs, and colocation operators have validated and approved Bloom for AI factories. They will not split live versus backlog versus definitive agreements, but the combination covers the set. Nebius this quarter canceled a combustion turbine order midstream and chose Bloom. 80% of orders booked in 2025 were repeats from customers who had already placed multiple orders. High 90s share inside the data center fuel cell niche, per KR. A bold claim, and he basically dared competition to show their megawatts.
Backlog outpacing revenue is the second order tell. First project lands, total economic value becomes obvious. Conversation expands from one site to a portfolio. Copy exact servers are fungible site to site, so the book stays nimble when AI site plans shift.
Capital got real airtime. Brookfield went from a $5 billion framework last fall to $25 billion in June, 5 times in 9 months after watching execution. IDF partnered with Oaktree, MUFG Bank, and Morgan Stanley for another $2.6 billion cumulative, and that structure was a meaningful contributor this quarter.
Simon walked the model for newer holders. End customer signs a CapEx sale or a PPA, capacity agreement or lease. Most choose pay over time, so a financier like Brookfield or IDF buys the servers from Bloom, takes title, and Bloom recognizes the cash sale. Financier owns the asset, end customer pays over time under the contract Bloom originated. Large campus deliveries are lumpy, so one or two names can dominate a quarter's revenue without meaning the backlog is concentrated. On delays, the financier is still on the hook to take delivery. The end customer can redeploy the fungible kit.
The moat is four frictions: capital, prearranged gigadollars, so the end customer needs no capital budget; community, no combustion, negligible air pollution and water use, quieter than air conditioning, so communities accept the servers and air permits come faster; permitting, every month saved is a month closer to token revenue; speed, power in months while the grid quotes years and legacy suppliers celebrate backlogs into 2029. KR said a 4-year backlog is not a trophy. It is a concession of constrained supply.
Multiple qualified suppliers across multiple countries for every critical input. Inventory ahead of the ramp. Copy exact capacity adds in American factories ahead of committed orders. They are saying capacity and supply chain are not the gate.
Proof of moat is that service journey again. Negative 21 at IPO to 22% this quarter. Fifth straight double-digit print. Revenue recognized ratably net of guarantees, costs as incurred, so stack replacement timing moves quarters. But underlying, they say 20 plus percent is sustainable on fleet performance, longer stack life, and scale. Happy customers show up as 80% repeat orders. That is behavioral evidence, not just margin math.
Q&A is where analysts pressure tested it. David Arcaro on Scandium. KR pointed to the blog and 8K. Enough economically recoverable scandium on the planet to power the planet. Visibility for 25 gigawatts of deployments, not dependent on China. Stockpiles stay proprietary.
Mark Strauss on capacity. No megawatt targets, but the algorithm matches increments to customer readiness. Units on a truck can be redirected, and capacity is not the constraint for the order book or what they see coming. He referenced 30 to 40 gigawatts of new AI data center capacity expected to turn on in 2027.
Project delay exposure. Both said 2026 guidance is not dependent on any single project. They bake in pushes, pulls, and surprise in-year wins. Hyperscalers grill them under NDA on committed orders, new order runway, and scaling path because these are multi-year strategic partnerships. Financiers add layers on full life availability and returns. Brookfield put $5 billion in, watched execution, and talked to customers going back 15 plus years, then multiplied the shelf by 5.
Ben Callow on turbines and engines. Near term, the supply demand gap is wide enough that every fast technology has a play, but when a customer chooses it as total cost to tokens, 800-volt DC, reliability without overbuild, city siting, permit speed, not LCOE. On other fuel cells, he put data center share in the very high 90s and welcomed competition as something that makes them hungrier.
Training versus inference and cheaper tokens from any lab. Both training and inference are robust for years. Inference needs distribution level power where you cannot drop a gas turbine in Manhattan. Jevons paradox: efficiency up, usage explodes, power demand goes up, not down. On free cash flow, Simon said they aligned the deck to formal guidance only, but the operating income raise should drop roughly 100% to cash from operations. Think 375 million plus as the new baseline, even without a formal FCF number.
Vision for the next 3 to 4 years. On-site DC as the primary source. Data centers, fleet EV charging, apartment microgrids. 90+% combined efficiency using heat for heating and cooling. Carbon capture they claim better than anyone. Same copy exact appliance format from hyperscaler campus to neighborhood inference node. Henry Ford framing. They cannot control whether AI investment keeps sprinting, but they control cost, quality, and availability. Factory ROI measured in months, not industrial age years.
Investor lens from their own words. Bull case: first $1 billion quarter at 34.3% non GAAP gross and 22.5% op margin, with structural leverage proven. 25 billion Brookfield plus 2.6 billion IDF shelf. Full hyperscaler validation in under 9 months with backlog outpacing revenue. 80% repeats and the service margin swing. Factory payback in months. Bear case: lumpy campus deliveries can make any quarter look concentrated. Blended gross margin moves with mix and expedite trade-offs. The 25 billion is a shelf, not deployed capital. 30 to 40 gigawatts in 2027 is an industry estimate and delays happen. Scandium disclosure is deliberately thin. Capacity still has to be executed.
Rebuttal on the call is consistent. Guidance is not hostage to one project, one customer, or one financing tranche. Diversity, fungibility, and the in year booking layer are the shock absorbers. Filings history: full year revenue from 1.2 billion in 2022 to 2.02 billion in 2025, and now a midpoint near 4 billion. Street had this quarter at roughly 826 million revenue and 39 cents of earnings per share. They printed 1.065 billion and 78 cents non-GAAP. The beat is not subtle. Working capital swings remain a watch item even with 2.7 billion on the balance sheet.
Takeaway from KR: chips without power are inventory, not intelligence. Milestone is the $1 billion quarter and the raise. Moat is the 4 frictions plus the capital shelf and the hyperscaler standard in under a year. Outlook is 3.9 to 4.2 billion revenue, 800 to 900 million of operating income, about 21% op margin. Near term, watch second half delivery timing against site readiness, whether backlog keeps outgrowing revenue, service margin holding in the 20s, and how fast the Brookfield and IDF shelves actually fund. If time to power stays the scarce resource in AI buildouts, their model is built for that. If slips cluster or AI capex pauses, the lumpiness and reserved capacity layer get tested.
That is the call as they told it. This is discussion and analysis for entertainment and education, not financial advice. Do your own work before you do anything with it.
Thanks for listening.